Sorry, this was a rough week for rates. On Tuesday, we had CPI, Consumer Price Index, the market's favorite inflation metric, and one of the two biggest reports each month. It came in above forecast, actually the second month in a row that CPI is coming on the high side. So rates unfortunately worsened on Tuesday. Thursday was PPI, Producer Price Index, another inflationary gauge, not quite as big as CPI, but in combination with Tuesday's data, unfortunately rates worsened again on Thursday and really continued through the week's close. So what does this tell us? This week coming up, we have the next Fed meeting, Tuesday and Wednesday. Now, on Wednesday, they aren't expected to make any change to their federal funds rate, their short-term benchmark rate, but they are going to release the dot plot. This is released quarterly, and this dot plot breaks down each of its projections for the federal funds rate over the next several years. If you remember back in December with the last one, it really justified the improvements we had received November and December based on this idea that inflation had turned a corner, it was trending lower, and it would allow the Fed to start cutting rates here in 2024. That graph showed around 3 cuts on average. The markets were betting on 6 rate cuts this year, the first one to start really here at this March meeting. But so far this year, report after report is unfortunately showing that inflation is not trending at the same pace, has grown a little bit stagnant, and that there are other economic indicators suggesting inflation might even pop back up. So I think this dot plot is going to reflect a bit of a shift in that mindset. Maybe fewer cuts, but more than likely reigniting that higher for longer narrative we heard so much last year. So how are we advising our clients? First of all, it's important to understand that the Fed does not control mortgage rates. However, economic conditions that do influence their decisions also influence mortgage rates as well. So, specifically inflation, we need to see consistent month-over-month data confirming that inflation is in fact trending lower before we're going to see a meaningful shift in rates. And for this reason, I think rates are probably going to stay in the sixes through the year. However, home appreciation is not going to be stagnant. In my market, Virginia, Maryland, and DC, it has been incredibly aggressive. We've seen very aggressive escalations. Low inventory is putting upward pressure on prices. So if I were a buyer, I would not want to wait for rates to fall before I jump into the market. I want to get into that property now, enjoy home ownership, and then refi down the road once rates fall, and you've been able to establish some equity. You have any questions at all about these numbers? You want to discuss your purchase power, your pre-approval options, and certainly your long-term financial goals? Definitely give me a call. I'd love to talk to you. Have a great week.